Hi, Mr. and Mrs. Carr. This is Ian O'Shea, your potential financial planner. Thank you again for coming in today. Now, as you know, we've been working together for the last few months for me to review your financial position. And when we got started, we had a number of goals that you wanted to accomplish and what you needed to do to reach your goals. But first, before I go into that and what I found, I thought I'd highlight some strengths and review a couple of the opportunities that I found when reviewing your situation. So let's take a look at your strengths. You're both two-income earners. You own a primary and vacation residence. Good on you. Your retirement plans are in place. It's awesome. And in my opinion, you have an emergency fund that is likely fully funded. On the opportunity side, though, I think there is some opportunity to update your estates, or your estate planning is needed. And I think we should reevaluate your investments based on performance and risk tolerance. So what I'd like to do today is a couple things. I want to take a look at what we can do to reevaluate those investments. And then I also want to review some steps I think you need to take on the estate planning side of things. Now, in order to reach my investment recommendations, there was some economic information that we agreed upon. You indicated to me that you expect inflation to average around 3% annually over the short and long term. You expected returns of about 10% annually on the S&P 500. You expected 90-day treasury bills to currently yield around 2%. Current mortgage rates are about 6.75% for a fixed 15-year and 7.25% for a fixed 30-year mortgage. And then lastly, mortgage closing costs were expected to be about 3% of any mortgage that we built into the portfolio. So again, you've done great with home ownership, you have a strong emergency fund, and your retirement plans are in place. But when I look at your investments, I think there's some room for improvement, right? Now, Lisa, you've been doing a lot of this on your own, and I found that the weighted beta of your portfolio is slightly above 1, at about 1.0828. That indicates that you're taking a little bit more market risk, which can be great when times are going well, but can be more challenging when times are a little bit tougher. You did ask me, in regards to your investments, to review what you should be concerned about in your portfolio. And I jotted down a few things that I wanted to go over. So on both the equity and fixed income portions of your portfolio, there were some risks. I did want to review the equity side of things first. Business risk. There's uncertainty over operating income and the future performance of the companies that you're investing in. Financial risk. That individual company's financial structure could hurt your investments at some point. Liquidity risk. Without knowing the specific names of the stocks in your portfolio and the health of the stocks that you own, you may be opening yourself up to liquidity risk. This means that your ability to offload or sell any of those securities quickly, say when the market downturns, would be very challenging, and your principal could be jeopardized. In the same context of liquidity risk, marketability risk is present in securities that have a thinly traded market and can be challenging to find a willing buyer. Kind of the same thing there. But your individual securities may also be subject to tax or political risk. Now, before I dove into that, I would need to take a deeper look at some of your securities to understand if those would apply. And then lastly, for your growth mutual funds, the one risk that is present there would be there and not necessarily in your individual securities is manager risk. Now, you see this a lot of times with some of these big, famous investment firms like, say, PIMCO Asset Management, where one-star manager does all the work. Because this is an actively managed fund, the risk associated with the skills and philosophy of that individual manager could be a risk. Now, while the risk is present, with proper research on both our and your side, I'm confident that we can lower this risk and make it minimal at most. On the bond side of things, you asked me what risks your current bond portfolio might be subject to. Now, there are a number of risks that your current portfolio may be subject to, and there are some that you might not worry about, and I wanted to just go over both of them. So let's take a look at your treasury bonds first. You are subject to reinvestment rate risk with your treasury bonds. Now, this is the risk that the proceeds available for reinvestment when you get your coupon are going to be invested at a lower rate of return and therefore not earn a better return than you currently had before. So bonds that have longer maturities tend to have more reinvestment rate risk. We'd be most concerned with Treasury C in this context. With your money market fund, you would be subject to purchasing power risk. Purchasing power risk is the potential loss of purchasing power of an investment due to inflation. Because you're most likely earning a return less than the run rate of inflation, you're subjecting yourself to losing purchasing power in the investment, and you might actually be at losing money in real time. And then lastly, there are fixed income risks that your holdings may not be significantly subject to. So I'll just breeze through those briefly. In your treasury bond holdings, you'd be substantially minimal level of default risk. This is because default risk applies to the potential inability of a debt issuer to pay back the principal and interest payments. Because treasury bonds are issued by the U.S. government, you're backed by the full faith and credit of our U.S. government. Chances of those holdings defaulting is slim to none. And then in addition, your treasury holdings would have very little liquidity risk. And again, this is because the U.S. government bond market is highly liquid and you have very little trouble finding a buyer if you want to sell your holdings. So that's it on the investment side of things. And we're getting a little bit long in the tooth, so I'll just go through a couple of recommendations on the estate side of things before we wrap up. Now, you both have simple wills drafted over 20 years ago, and you asked me to advise on steps and priorities in implementing proper estate planning to explain why those recommendations are important. So based on your current life situation, your wills are in need of updating. You should consider, however, hiring an estate planning attorney to help update your wills to more complex ones that can handle estate tax planning. This will allow you to leave property in a tax efficient manner as possible, because you are, again, in a pretty healthy financial position. Now, you also asked me to help you out to provide income for Lisa in the event that you, Robert, die, while guaranteeing that any assets remaining at Lisa's death pass on to Robert's children equally. Well, there's actually a financial product, an estate planning product designed specifically for this request that we refer to as a terminable interest. That is, Lisa's interest in income from Robert's death would end when she passed away and would go to her kids, or his kids, excuse me. Now, in order to structure this in the most tax-efficient way possible, we need to establish a qualified terminable interest property, or a Q-tip or C-trust. Now, a C-trust allows a terminable interest to be left to a surviving spouse and for the property to still qualify for the marital deduction at the descendant's estate. Now, we would need to make the executor of Robert's estate aware of this election, because this type of trust is typically more attractive to folks in a second marriage, which you are in, where the first to die may have children, or if the spouse is to die, is concerned over the surviving spouse may remarry. Sorry, Lisa. Now, Lisa would still have a limited power of invasion on the corpus for, say, expenses related to her health, education, maintenance, and support. But when she passed away, any remaining assets in the trust would pass to your children, Robert. So again, in closing, I appreciate you taking some time to meet with me. I think you both are at a very strong point financially. And with a few minor tweaks to what I mentioned in both your investment planning and estate planning, I think you're well on your way to meeting your long-term goals. Thank you again for your time.